It's 11:37. I'm still not trading my strategy consistently profitable yet. It's a very difficult strategy to execute because it requires perfect technical analysis. What I mean by perfect is analyzing a market on 3 different time frames and not missing the interaction of any level, be it diagonal, trend line, or horizontal, the pivots, support and resistance, or Fibonacci levels, and then you got to find a bullish RSI divergence or bearish, depending if you're trading long or short, in the same place. You can see my ebook is on tinyurl hashtag 84 Hotel Lima Bravo 8 Lima. That's my ebook on RSI reversal setups. But I'm only looking for the classic divergence or a double bottom divergence. Of course, if you're trading short, it's just the reverse. It's just a double, and that's not actually even backwards the right way. So I'm just looking for those two signals, either on a support level or on a diagonal trend line, or the junction of both. And I'm real picky that if I don't see my entry point right there exactly when the bullish divergence occurs, then even if I see it right here, I don't take that entry on, and all I gotta do is take it on, have my stop in the same place, and cut my leverage in half to keep my risk equal. So I'm just looking for that setup, and I've found that when the divergence is more than 5% on a key level, it was the first time the market overbought or oversold, and if it's part of a double divergence, and those can be very strong signals. And there's only 14 possible places that a trade can occur. We only have break of support, break of trend line after bullish divergence. Oh, there's the fast money move where you just get involved in some heavy kind of selling pressure, or there's a classic entry where we get support acting as resistance and we take a short right there at the first test of it. We also have the trend line retracement, which is the same as the classic, except the level is diagonal to trend line, not a support level. There's a classic fib retracement, and then what I call a classic fib is when you go into the inferior time frame. So this is the 5-minute chart, you go right to the 1-minute chart to get a bearish divergence there, and the same for the classic RSI that I've called. If this is the 5-minute chart, if there's no bearish signal in that time frame, you switch to the 1-minute time frame and you get a signal that would confirm that level is going to hold. And that's basically just a basic RSI reversal setup. So you have your naked RSI divergence that I don't trade. There's the basic RSI reversal setup on a level. You have the double bottom divergence, which I mentioned, or you have divergence on a trend line, or the cluster strategy, which is the horizontal and trend line together. And the last place to enter is the third test of a new intraday trend line, and it's best when we're at a day low, and maybe there could be a little bullish divergence there. But the bullish signal is not needed, it only increases the probability, and more than often a third test will hold if you get it on the trend line support after the candle completes above the trend line. So there's only 4 really good RSI strategies: the double bottom divergence, the trend line divergence, the RSI reversal, or the cluster setup. And I've done an influence diagram with some nodes, and RSI is the heart of it. The trend line or the horizontal level, you have RSI divergences in inferior time frames. For example, if we don't have any RSI signals in the 1 or the 5-minute chart at a point of market instability, which you could call a point of price instability, then it's a zero momentum price reversal. There's no predictive value. But if we get to a level and there's no signal in the 5-minute chart but one in the 1-minute chart, it's a low momentum price reversal. High has signals in the 1-minute and the 5-minute. For example, as we get to that point of reversal, the signal could be here, very close to it in the 1-minute chart, but in the 5-minute chart the signal might be across other peaks. So there will be a divergence between these main peaks in the 5-minute chart, but there could be 2 little peaks right there in the 1-minute chart that will also have a divergence. So you can see how it gets nested. And if we go to a longer time frame, it could be a series of higher highs in the daily chart. So you could have a divergence in price in the daily chart, the hourly chart, and the 5-minute. So that's what I call fractal divergence. That's what I've made up about momentum changes. So when I'm doing 20 trades this week, I put all the trades on the wall and I've numbered them all the way across here to 18 and then 19 and 20. So when I do a trade, I need to write down which nodes the trade setup involves, and it's my idea that the more nodes you can connect, the higher the probability, because it strengthens your reasoning. And I just got to fill out what the leverage is, what the results are, what R is. R is just the outcome. Like if I'm going to manage risk and position size my trades, I'm going to use a 1.5 times average true range as my stop, and then I'm just going to take 5% of my capital, divide it by the average true range, times it by 1.5, and that will give my leverage. So that's how I'm going to manage risk. 5% position sizing with a 1.5 times ATR stop. And eventually, when you look back at 100 kind of trade setups, you'll be able to count the nodes and see the outcome. And it's my idea that you'll be able to give a weighting to each one of the signals if you compare all the results, and then you'll have a better probability distribution for how these trade setups are ranked, because I believe that these RSI reversal strategies can be ranked from low to high probability. That's why I've arranged them on the page from left to right. Obviously, a reversal on 2 levels with a bullish divergence is more probable than a reversal on just a trend line. And then this signal here can get stronger if we have, say, 2 horizontal levels, like the previous day's low and the daily pivot in the same place, and the trend line. So that's 3 signals with a bullish divergence. So that's 5 signals, and then you can make 6 signals by going down to the inferior time frame, and then this reversal peak right here might be a high momentum price reversal. So we could have an RSI signal in the 1 minute chart and the 5 minute chart. That would be 2 signals. We could have a setup with a trend line, a pivot, and a support level. That's 3 more signals. That's 5 signals. So you can see how when you look at the trading results for your strategies 1 through 13 that can be mapped onto my influence diagram, when you look at the results for the node, for how many nodes led to positive outcomes with a 1.5 ATR, you'll eventually get a very accurate weighting on each one of these vertexes that connects the nodes, so that with iterations and averaging it out, you'll be able to narrow down and get those weightings more specific, I think. Well, that's kind of, without going into, I guess, the basic mathematics of how you do that, that's what I'm trying to do, basically. So that's my video on trading this week, and high probability quantitative trading, really trying to get high probability entry points that offer a high risk to reward ratio, because when I risk R, I'm booking my profit at least 2R on all the trades, and you know, I gotta hang on to my profits. That's one of my biggest problems with trading. So it'll be interesting to see what the results for R are also, because when you look at which strategy that you took and how you had a trailing stop with a specific approach, eventually you might see that each one of these setups will offer different R. For example, this one might more than often yield 2R, this one could yield 3R, this one could be 3R, and this one, if you catch the day low at a strong reversal, and then you have strength on the upside without very many pullbacks, it could work out that this cluster strategy could offer 4R trades. But you got to have a set methodology for where you take profit or how you bring a trailing stop behind. So you can see how you'll be able to rank the probability of the setups, how common they are, and after doing this for 4 weeks, you'll be able to work out your percent return per week and make a projection on the future if you have a solid strategy with an edge.